My overall perspective is bullish gold and silver. We had a physical squeeze in London. And I think that's what made silver really perk up. And this is actually good news, because that physical squeeze, that, I know that there's some uber bulls that think this is it. Silver's going to the moon. The shorts are all going to be busted, and silver's going to triple digits next. Yeah, maybe.
As you and I talked last time, I thought we could get to 4,500 this year, and we did.
Yeah.
Again, it's hard to read from where we are here. One of the problems we have is a lack of volume, but certainly neither would surprise me. A big rally, I wouldn't say by November, that's 2 weeks from now, but if we could get to 5,000 by the end of the year, is it possible? Yeah. Listen, we're up 56% this year. Another 20% or another 15% would not be shocking.
Gold and silver are moving through one of the most critical phases of their bull cycle, an explosive rally tempered by necessary corrections. After a historic surge, both metals are testing the discipline of investors who've waited years for this moment. While emotions run high and the temptation to call a top grows louder, what's really unfolding is a classic case of market maturity. Prices that rise too fast must cool off before continuing higher, and this temporary turbulence is not weakness, it's resilience in motion. The key lesson now is strategy, not panic. The real winners in these cycles are the ones who know how to protect profits without walking away from opportunity. Lobo Tiggre, editor of the Independent Speculator, and veteran trader Todd "Bubba" Horwitz, both argue that in parabolic markets, the most brilliant move isn't selling out completely, it's locking in gains while keeping enough exposure to ride the next leg higher. The upside maximizer strategy, as Tiggre calls it, ensures that investors secure wins while maintaining skin in the game. With gold firmly above $4,000 and silver supported by strong physical demand, the long-term outlook remains bullish. Corrections like these aren't endings, they're resets before new highs. Now we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
My overall perspective is bullish gold and silver. I do not think we've reached the top for this cycle. And people are going to say the opposite in the YouTube comments, but oh well. That having been said, whenever something goes vertical, whenever something goes into hockey stick mode, it is reasonable and prudent and experience-based to at least pay attention to that and understand that that can't go vertical forever. Like, no price can go in a straight line up forever. And the longer it does, the more likely the correction and the more extreme the correction is likely to be. If something is, going up at a reasonable pace, it's not so likely to come screaming down. Or there are a lot of conventional market wisdom words here, adages and things. Like, for example, the markets will take the stairs up and the elevator down. That sort of thing. That's based on real world experience, Elijah. So I'm not saying the market is stopped. I'm saying it is reasonable and prudent to make sure that you don't let a big move up like this slip through your fingers. This is the number one message I've been really pounding the table on the last week or so. And I have gotten a lot of hate on social media. But I'm not telling anybody to sell out completely or that the market is peaked. I'm saying make sure that your big wins don't slip through your fingers. Imagine you're some long-suffering gold bug who's been waiting years or decades for something like this. Do you imagine how bad it must feel to be right and then not make any money on it? That's really the point here. Is I'm not making a bear case. I am saying that nobody should lose the opportunity on the table. Nobody should be forced to suffer being right about the market and not make money off of that. So choose your own strategy. I have something you and I have discussed before called the upside maximizer. You don't have to copy me. You can do it however you want, but don't let big wins slip through your fingers, because nobody knows what happens next. First and foremost, I do still see silver as a monetary metal, and it has been tracking gold more closely this year than copper, which may sound like, well, duh, it's a monetary metal. Well, but it wasn't last year. It was tracking copper more closely than gold last year. So I'm very encouraged by this action because I'm bullish gold. And by the way, I'm bullish copper as well. So how can you be bullish gold and copper and not very bullish on silver? So it's The very last interview I did, I think I said something similar. And like clockwork, one of the first remarks was, this man hates silver. Oh, well, what can you do? Anyway, but the reason why I'm teasing this apart is because silver did have its own unique drivers in this leg up. It wasn't just tracking gold. It started zooming higher. My interpretation is not unique to me. A lot of people were commenting on this. We had a physical squeeze in London. And I think that's what made silver really perk up. And this is actually good news, because that physical squeeze, that, I know that there's some uber bulls that think this is it. Silver's going to the moon. The shorts are all going to be busted, and silver's going to triple digits next. Yeah, maybe. But if not, if the folks at the LME can sort out the physical supply issues now, and there is data that suggests they are as we speak, then I think silver, it doesn't necessarily go down or go into a bear market. I'm not saying that. I'm saying that the extra oomph that it got from the short squeeze goes away, and then silver goes back to trend. And for all the people who says, oh, he hates silver, not at all. I think this is very good for both gold and silver, because if silver really was finally catching up to gold, even your most diehard silver bulls will tell you that silver usually lags gold at first and then more than catches up at the end of the bull market. So if we were in that catch-up phase, that would signal the end of the bull market. And I don't think we're there. I'm a fundamentalist. I don't think we're there for all those reasons we articulated earlier. I don't want it to be there either. I want it to go higher. Mr. Market doesn't care what I want. But I neither want nor think that we're at the end of the market. So silver catching up to gold was a concern to me. Silver catching up because of the physical squeeze in London that did not apply to gold is a huge sigh of relief for me. And, we'll see where it goes next. This does mean I think that there's potentially more volatility to the downside in silver in the near term than in gold. But, that's not a surprise to anybody in silver and gold. We all know that silver is more volatile than gold. I'm just saying beware of an extra spicy near term for silver. And if you're a bull, hey, that means more buying opportunities. And by the way, if you exercise some upside maximizers or whatever strategy you used, if you locked in some gains and now you've got extra cash in your trading account and we do get a sale price, well, that's a good thing. If you're an uber bull, the worst thing in the world is to have an obvious buying opportunity and no cash to act on it. I remember this in 2008. In late 2008, like particularly November, December, I had a lot of readers, they were long-term bulls. They got it. They understood that gold correcting down to almost 700, that was an opportunity. But the agony that I could hear in their voices, reading between the lines in the email, the agony was they see it, they understand it, but they were all in. They had no cash to act on it. So this is another reason why one should not let profit slip through your fingers. That doesn't mean you're a bear. It means, A, you don't want to lose money. Rule number one, don't lose money. And two, it means that you're providing for potential future opportunities. Gold and silver keep screaming high from here. I will make more money. But if that's not right, if it goes crashing down to, let's say it goes down $1,000 an ounce, Elijah, that's still well over $3,000. That's a great level for which the miners can make money. So it's not the end of the world. But of course, the stocks would just tank. So, if this stock goes way down, I've not just gotten my money back off the table. I have a double off the table. Like the very worst thing that can happen to me on this upside maximizer execution is like the thing goes to zero and I get not a penny back for the rest of the money I left on the table. I will have a guaranteed double in my hands, including fees, by the way, no matter what happens. Breaking below 4,000, easy. 37, 38, not hard to imagine. I'll be surprised if it goes much lower than that. I'll be surprised if it hits 3,500. I'll be very surprised if it goes below 3,500. These are not promises or predictions. I'm just giving you my wolf whisker sense of the odds here to give you some numbers. That 3,000 number, it makes me nervous that you keep using it because I would be extremely surprised actually if we got that low. I think that the central bank gold buying, I think the global allocation, the political risk, the global reallocation, Rick Will's famous 2% versus 0.5%, all these things happening right now. And not to mention inflation. The Trump agenda is highly inflationary. I know Trump fans hate it when I say that. That's not necessarily a criticism. Whether you agree or disagree with Trump's agenda, it is inflationary. Come on. I mean, Doge did not save us $2 trillion. Europe's rearmament is highly inflationary. Russia's war is highly inflationary. The only one that's really been dealing with something that at least reportedly looks like deflation is China. And ultimately, they just announced a new 5-year plan. So ultimately, the printing press always wins in the end. So all of these reasons, I think, are solid reasons to remain bullish on monetary metals in particular, but commodities as a whole. I like copper and uranium, other things too. Sometimes I'll even leave the profit on the table and just recover the initial investment. So I'm risk-free. I really like it. And I'm bullish on the commodity. I'm bullish on the company, the project, the country, all these things. I'll leave most of the money on the table and only recover my initial investment so that I can't lose. It depends. One size doesn't fit all. As I say, the only way to do it wrong is not to do it at all. I'm not making a bear case. I'm simply saying, dear reader, nobody knows what the next move is going to be. And how will you feel if you let some gain slip through your fingers? And by the way, if the next move is down and you took some profits, now you have cash to take advantage of that. If you're all in right now, how will you feel if there's a sale price in a month or two and you have no cash to act on it? And the answer is, well, Lobo, what if it goes to the moon? Well, I've just answered that. I have more money now in the market than when I started. So if it goes to the moon next, that's fine. Okay, maybe my 10-bagger turns into a 7.5-bagger instead of a 5-bagger. It's still 7.5 times my money. That's a fine outcome, Elijah.
Gold's historic surge to new highs this year has triggered waves of excitement and confusion alike. After climbing more than 56%, momentum remains strong, but so does the likelihood of short-term pullbacks. These retracements are not signs of weakness, but rather symptoms of an overbought market finding its balance after an extraordinary run. Central banks around the world continue to accumulate gold, signaling their awareness of the fragility in today's fiat-based system. The disconnect between rising asset prices and declining purchasing power has become impossible to ignore. Decades of unchecked monetary expansion have devalued currencies globally, turning once sound money into little more than government-backed debt. This growing recognition is fueling the shift back toward tangible assets. As inflation pressures persist and rate cuts erode confidence in fiat instruments, physical gold and silver remain the ultimate hedge, offering not just security, but sovereignty. The future monetary order is already being shaped by those who hold real value rather than paper promises. Let's get back to the interview.
As you and I talked last time, I thought we could get to 4,500 this year, and we did.
Yeah.
Again, it's hard to read from where we are here. One of the problems we have is a lack of volume, but certainly neither would surprise me. A big rally, I wouldn't say by November, that's 2 weeks from now, but if we could get to 5,000 by the end of the year, is it possible? Yeah. Listen, we're up 56% this year. Another 20% or another 15% would not be shocking. Okay. I think that there's a greater probability of a pullback, a continued pullback, and not because there's anything wrong with the gold. When markets get overbought, when people get over leveraged, when the FOMO finally wears off, people wonder where their capital is. It's like any other market. When they get overbought, they're normally going to pull back. And we're certainly, we got to about 5 or 6 standard deviations away from the mean on gold, which is too far. It cannot exist at that pace of going up. There's not enough money to continue to support it. We just saw it in silver. Silver ran to $54 almost, all-time new high, and pulled right back to 49, 48. Look, you expect pullbacks. You can't go into a market thinking that it's going to continue to go up. You get these big dramatic up moves, 56%, 70% in platinum and 80% in silver. There's going to be a pullback. Don't worry about it. Use that as a buying opportunity. Look, precious metals have not changed, and with central banks participating in buying them, that's telling you that we need to have that as part of everybody's portfolio. I don't know, but I know that Bissett would like to see something more of a gold standard or a Bitcoin standard, or something, an underlying asset that controls the dollar, that values the dollar like we used to have before Bretton Woods. Again, I think one of the problems, and I think what we've seen in this country since the end of the gold standard has been not really, really good. I mean, you look at 1985, which is, 10 years past Bretton Woods, but the average income was 25,000, the average house was 75,000. Today, the average income is 70,000. The average house is over 500. So the ratio is not good. The damage that they've done with the fiat currency system without any underlying asset has ballooned many asset classes out of control because people just trade the interest rate and the money. They're not really buying a house. They're buying the money. That it's a buy the month society. So I would suspect that central banks will continue to accumulate, and I would suspect that at some point that Besant and Trump are going to try to get some kind of underlying asset to back the dollar. Our paper money, our fiat currency globally is worth toilet paper. Okay, it is worth nothing, and that is hence the reason that they're accumulating hard assets, because hard assets hold value and they're not a debt to the government. The government's not borrowing money. You're holding a physical asset, and that's what I think they're realizing, the damage that they've done with their, we're not going to call it money printing, their debt creating, their inflation creating policies. Okay, so they're now collecting and accumulating more gold to help protect themselves. So, the Fed is a cartel of a bunch of ridiculous people that have no clue how a free market really works. It's amazing how well educated they are, and when they become members of the Fed, they become instant morons. You have a system that is not helping. Them cutting rates, which is probably what they're going to do, okay, is not helping anybody. When you're in a K-shaped economy, which we are, which means that you're destroying the middle class, okay? The wealthy are getting richer, the poor are getting poor, okay? The middle class is being wiped out. So it depends on where you sit. And again, if you live in New York City, for example, if you don't make $150,000 a year, you're in poverty, okay? At the end of the day, a rate cut is going to spike inflation. We're already seeing higher inflation from the last rate cut. And what people do not understand is a rate cut does not necessarily benefit the borrower. Okay, it only benefits for sure the banks, because the Fed funds rate, when they cut it, that is the lending rate to the banks. Okay, it has nothing to do. They don't have to pass the savings on. So from the last rate cut, or we go back a year to the first time we started cutting rates again, only the banks have benefited. The 10-year notes are higher than they were a year ago, yet we're 150 basis points lower on the Fed funds rate. So they'll probably cut because that's what they do, and they do ridiculous things because, unfortunately, they don't let the free market trade. True interest rates, if you go to the peer-to-peer lenders, are well north of 10%. Okay? Mm-hmm. So, again, it's silly what they do. Warren Buffett is a billionaire. Okay, a multi-billionaire. He runs a big fund. He got lucky. He's a smart guy. I'm not a fan, but he's a smart guy. Built a beautiful business. It's easy when you have that kind of money to say that you don't need any underlying asset to help protect. Gold is a great inflation hedge. Listen, you see what's going on in New York, in your city, with the potential to the new mayor. And again, we've seen what's going on with the presidencies over time. I mean, because it changes every 4 years. You may need gold and silver as a currency someday again. There could be another revolution. So not only has gold shown growth in history as it grinds higher and protects you against inflation, but what happens if? It's a great asset class to hold, and I think everybody should have 5, 10, 15% of their money tied up with physical metals that they buy in real hard assets that they can put in their safe in a box or store somewhere, not the paper crap that you buy, because I don't believe there's enough gold in the world to cover all the paper that's out there.
Trajectory of gold's rise tells a larger story about the failure of the fiat experiment. Every surge, every correction, is part of a broader repricing of trust. A slow awakening to the reality that printed promises cannot outlast tangible value. The shift is no longer theoretical. It's visible in central banks' actions, in the erosion of the middle class, and in the quiet exodus from paper wealth into tangible assets. While policymakers continue to chase short-term illusions through rate cuts and stimulus, the market is making its own statement. Sound money is reclaiming its place. Gold's resilience above $4,000 isn't just a number, it's a verdict on decades of fiscal mismanagement. The physical market, not the paper one, is now dictating price discovery. As governments double down on debt and inflation silently rob savers, gold and silver remain the ultimate defense, not just against volatility, but against systemic decay. These moments of pullback are gifts for those who understand that real wealth isn't earned through speculation, but through preservation. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.